welcome to the panel, DeFi and scalability thing. I'm Kenji Mitsada, head of markets in Secure Finance. Let me introduce myself quickly. I used to work as a trader in FX and rates market in Goldman as well as a hedge fund before joining Secure Finance. And Secure Finance is a peer-to-peer lending and borrowing protocol. Make a yield curve for crypto asset up to 2 years, full on-chain order book system. In addition to that, we are launching stablecoin in coming month, backed by the Filecoin. Having said that, let's give us a quick intro, each of you. Starting from Matt from Redstone.
Hi everyone, the name is Matt. I lead BD for Redstone, which is an Oracle provider. So we provide pricing data for collateral assets on chain, and we mostly focus on the lending use case. Some of the notable clients include Spark from MakerDAO, Pendle, Morpho, Venus, Silo, Compound, and many, many others.
Hey everyone, my name is Vivek Saini. I'm at TrueFi. We are a RWA tokenization and under collateralized borrow lending protocol. Pretty exciting stuff in store for us. We are getting ready to launch a yield-bearing stablecoin that we're pretty excited about. And I'm sure you'll hear more about it later in this talk.
I'm Leo. I work at Starkware. Starkware builds ZK magic in a way to scale while remaining decentralized and also bring privacy. We've done a lot of things over the years. Notably invented Stark proofs, which is the ZK magic that powers a lot of scaling solutions today, actually under the hood. And most of the magic that we built is productized and embodied within StarkNet, which is a general purpose L2 that we help build.
Okay, great. So I'd like to deeper a little bit more detail of each individual project. And why don't we kickstart with Leo, Starkware. Since Starkware's scalability solution is often highlighted as the key to DeFi scalability. And can you share and elaborate your technology? What will be the key? And what's the most different from the other projects?
So the fundamental key is that ZK lets you do a lot of things off-chain and have them be proven on-chain for a very, very low cost and very quickly. That's really the crux of it. ZK also allows you to add privacy to that. That's not something that we haven't seen of a focus that much in the space so far. The focus has been on scalability. But the fundamental point on scalability is that you do a lot of things on-chain, create a proof, post a proof on-chain, verify the proof on-chain. The challenges when doing that, and a lot of the work that we're doing, is how quick and cheaply can you create that proof, and how quickly and cheaply can you verify that proof. And a lot of the building, the thinking, the research is around these areas. But in a nutshell, that's really it.
So, Starkware, do you have any, can you elaborate or more specific use case or any example project if you can share?
Yeah, so Starkware started out building a product called StarkX, which was the first, call it, embodiment of this ZK tech. StarkX was, one way to think about it, it was a scaling solution on Ethereum for projects that are very sort of more trading focused. So we had both, we work both today with DEXs and purpose exchanges and also projects more in the NFT space that need particular scaling solutions for particular trading use cases. That's very much what StarkX is focused on. It was used, like one example I'm sure many will know is DYDX used StarkX for many years to become successful. Starknet, in a way, is a generalization of that technology, and it went from being very trading focused to just being any type of computation can now be scaled efficiently and cheaply with ZK, and just provided a ton of compute for sort of any type of application. Yeah, that's I think how
Yeah.
I would summarize it.
Fantastic. Yeah, I was shocked when DYDX moved to the own chain, which is based on a starware, and it's so quick and cheap, somewhat. So yeah, I got impressed. I remember. And Daniel, give us a quick intro. Yeah, which we already have done. So
Awesome. Hi everyone, I'm Daniel, the head of DeFi at Polygon Labs. So I help grow Polygon DeFi across multiple products, Polygon POS, the net neutral egg layer, and then also Polygon ZK EVM. So that's the quick intro.
okay, thank you, Daniel. So Polygon, needless to say, one of the leading L2 Ethereum solution. And Polygon has been significant success in the DeFi space in terms of scalability already. But what are the key factor behind the success, and how do you address the continuous, changing demand from project side as a L2?
Yeah, I would say like the DeFi scene is definitely one of the most mature verticals out there in general. So Polygon had a really nice run. So I think a lot of people from DeFi Summer remember like Goose Finance, etc. from back then. So like changing demands, I would say it's definitely that if you look at how DeFi has started, for example, Uni V2, Uni V1, and then now we are even on the V4 track, right? It's that it has definitely like became more sophisticated. So for example, you're not gonna see a general retail user just LP V4, for example. He's gonna do V2. So, but at the same time, DeFi also has its challenges in terms of bringing on the next generation of DeFi users. We've seen quite a lot of success with, like, for example, Moonshot and what Solana is doing. So Polygon's trying to push the frontier on that front. So we want to essentially make it so easy that users can actually access Polygon DeFi in general. So both POS and ZK EVM. And right now we are working on like kind of a fresh experience for a lot of DeFi users that would be able to access the Polygon ecosystem. Another piece that I will quickly mention is about the egg layer. So the egg layer is like essentially we see it from the DeFi perspective as a liquidity hub where chains can actually be connected to the egg layer. The future vision is that L1, L2s, and essentially even permission chains could get connected and actually draw on the users and liquidity that could actually benefit from that front. A good example that I want to bring up is like Immutable. So Immutable is like super focused on like their market leadership on the gaming front. But they might not want to spend a lot of resources on like bringing in like 200, 300, or 500 million in terms of TVL. But that's where like they could access liquidity through the egg layer from other origin sources. It doesn't matter what the origin is. It could be coming from any chain at all. And that way, they will be able to focus on the app-specific growth. And while other DeFi sources can actually like be pushing the liquidity into their chains. So that's like a majority of our focus right now. Yeah.
Interesting. Just curiosity, you guys changed Matic into POL. Is that any reason behind, or I mean, it's a Matic is already established brand, and if you change that to something else, has another cost. But yeah.
Yeah, I mean, maybe quickly explaining, like POL basically means like Polygon Ecosystem Token. So if you see like in the initial stages of Polygon definitely was just one chain, right? It's Polygon POS. We have since expanded to multiple different products, and Polygon Labs is pushing the frontier of like on multiple fronts. So this rebranding is definitely pretty apt for us, and it definitely did came with like certain tokenomics change prior to this migration. Yeah. So
Okay, makes sense. Thank you so much for your insight. And now, Vivek, TrueFi is a DeFi protocol, right? And I thought it's TrueFi is known for uncollateralized lending, and it sounds quite unique approach as a DeFi like us. And how do you manage those risks as well as what safeguard are crucial for your protocol?
Yeah, so at TrueFi, we're trying to do something quite different from the rest of DeFi. DeFi is all about being permissionless, being very capital efficient, but some of the assurances that centralized finance offers borrowers and lenders regarding credit risk, being able to under collateralize, just don't exist in DeFi. So we're trying to at TrueFi be a bridge between TradFi and DeFi and bring a lot of the TradFi-like experiences that you could get from going to a bank on the permissionless rails that DeFi brings. Yeah, so we started off as an under collateralized borrow lending protocol, but over the last several years, we've expanded more broadly into RWAs. We see that as a very good fit between DeFi and traditional finance, as there's billions and billions, trillions of assets in traditional finance that has yet to be tokenized, and why not tokenize everything? So we've expanded into the more broadly bridging TradFi and DeFi over the last several years, and continuing to do that over the next couple of years as well.
Fantastic. Okay, let's move on to Matt. Redstone. It's oracles are the backbone of many DeFi. It's essential. And how does Redstone ensure data accuracy as well as reliability? And what would be the difference between the other oracles providers, if you can share?
Sure. So yes, security and reliability and uptime of the Oracle is of paramount importance. There isn't like a 99.9 SLA on an Oracle. You have to be 100% always up, always running, and always accurate. So there is, in general, a couple of layers of that security. First and foremost, we start on the data source level. So we specifically take those prices from DEXs and SEXs, and we have to make sure that the price that we take is accurate, is not manipulated. So we actually use a liquidity-based approach to pricing as opposed to volume-based, which is traditional in order books, order book exchanges, and some of our competitors also use volume. But liquidity is harder to game. If you want to skew a liquidity pool on Uniswap, you have to put your own collateral and capital on risk, and then be prepared to be heavily arbitraged by everybody else on that market. So liquidity is kind of expensive to game. That's why we use liquidity as kind of a proxy for the quality of the data source. Going up a level, we have the Oracle nodes that basically collect that data from data sources, pack those data points into packages, and push that to our decentralized cloud where all of the price feeds live. So that part has to be decentralized. And then the cloud part, or should I say decentralized cloud, this is not exactly a cloud, but this is a couple of services, decentralized services working so that the price feeds can also be available at all possible chains. This part also has to be decentralized, always up and running. And the last part is, I would say, the last mile delivery of data. So usually there is a bot on chain that queries this decentralized cloud and pushes the prices to a price feed contract on chain. So this bot can also never go down. You have to have 2-3 layers of monitoring on top of that, just to make sure that even if it breaks, there is always another bot that can replace it. So in general, quite a lot of DevOps challenges when it comes to how do we make sure this infrastructure is redundant enough to never break down, but also when it comes to combining the data points and making sure it's all accurate, it's quite non-trivial to be able to tell if a price is corrupted or not. And when it comes to the competitors, I would say the two biggest ones are obviously Chainlink and Pyth. The main difference is to Pyth, this is easy. Pyth mostly focuses on things like perpetuals. We mostly focus on things like lending markets, which is quite a different use case. They use different types of assets. Specifically, lending markets like to use yield-bearing collateral to do looping. So that's kind of different areas of the market. When it comes to Chainlink, I would say we more closely compete with them. But Chainlink is a big organization in general. So they are usually not the first mover when it comes to the new segments of the market. We were the first in LSTs, in LRTs, in some of the yield-bearing stables or crypto dollars like Ethena, Elixir. We are the first in Bitcoin LSTs as well. So this is kind of this timing game that we play with Chainlink, but so far so good. They are kind of, I'd say, 2 steps behind on that front.
Very interesting, unique, and solid, I can say. One question actually I have is, you guys are providing Oracle for the commodities even? Are you? And that's, let's say like traditional asset class, there's a off-chain data, and the gap between crypto area against those TradFi asset is 24/7 or they close, right? How do you manage those the price during they are closing trading?
Right. So as far as I know, we don't really have any specific use case on production using commodities pricing. But what we've seen people try to do is you basically have the standard spot market in the operating hours. And then after the market closes, you basically have kind of a synthetic market, kind of like an AMM, based on supply and demand. And then sort of the market switches between those 2 modes, which is also non-trivial in terms of making sure the transition is smooth between the weekend and the working days as well. So to be honest, not too many protocols doing this today. There is quite a couple of protocols doing like fully synthetic instruments based on commodities. But when it comes to trying to be in and out and trying to be as close to spot as possible, it's kind of non-trivial. So to be perfectly open, I think we don't have any use case right now on production of that.
Right, interesting. I mean, if talk about the RWA and institutional clients, and they try to bring the equity and treasuries and bonds to, blockchain, and if we keep opening 24/7, and how do they manage the Oracle is my always have a question. So yeah, it would be great. Thanks for sharing. So I would like to ask next question. DeFi is changing rapidly day by day with technology, and many use cases happening every single moment. And let's look to the future in the next 12 months. What major innovation or development or trend do you expect to see in DeFi, and how is your protocol position for that? Okay, let's start from Matt and go this direction.
Sure. So the thing that we've seen over the past couple of weeks is what has been called as the DeFi mullet by Morpho team. So you have CeFi on the front, and you have a decentralized backend, basically, in the form of the integration of Coinbase Bitcoin lending with Morpho infrastructure. And I believe this is going to be more and more of a use case because it really, really makes quite a lot of sense for both parties. For Coinbase specifically, they could have used potentially something like Aave, but Aave is more like a fund. It's basically an actively managed fund where the code base is always changing, which creates a backdoor to Coinbase's system that another team has access to. Not the case for something like Morpho, which is an immutable infrastructure for building lending markets, so like building Aaves on top of Morpho, because then Coinbase can just spin up their own vault, which is immutable, there is no backdoor, and they can actually provide that on their interface in the Coinbase app. So you have centralized exchange on the front end, and the back end is decentralized. I think I'm really excited about things like this because this shows the product advantage of decentralized infrastructure, which is permissionless, which is immutable, and which is safe even for something as big as a publicly listed company on the New York Stock Exchange. So I'm definitely bullish, and when it comes to how Redstone is exposed to that, we are an Oracle provider to Morpho Vaults as well. So we're kind of in between and providing prices just to make sure all of those markets stay secure at all times.
Very interesting. Yeah, the merge between the centralized and decentralized would be helpful for the scalability for sure and mass adoption. Okay, Vivek.
Yeah, I mean, I totally agree with Matt that in order for crypto to grow rapidly over the next year, new money needs to come in. DeFi, as we've seen it, existing DeFi degen users isn't really growing at the kind of pace that requires crypto to grow. So institutional money needs to come in. It will come in. And how does DeFi better prepare itself for that inflow of money and their needs is the big question over the next 6 months to a year. At TrueFi, we are all like very deep into DeFi. We're DeFi nerds, and we are trying to package a lot of the innovations and yield sources in a way that's very, very appealing for institutions and bridging that gap, as I mentioned earlier. So, for example, on the yield-bearing stablecoin product that we're going to be releasing in the next few months, we're really excited about blending yield from things like treasury bills, which TradFi institutions are very used to and they know how to deal with very safe DeFi yield. DeFi yield is really interesting. It's complex. If you don't know how to interface with it, institutions are not going to know heads or tails on how to put money in and how to allocate it where. So blending the yield from DeFi with something familiar like T-bills is one aspect, one way we're going about making DeFi more accessible. We're also super excited about yield amplification and other like little DeFi shenanigans that we can do to make on-chain rails more interesting for TradFi institutions. But that's how we're positioning ourselves over the next 6 months to a year.
Actually, similar to us. The stablecoin and the RWA in bills, US rates and stuff, that could be the trend for next 12 months, I guess. Yeah, totally agree with that. Okay, Daniel, what's your point?
Yeah, so I think the first two sharing was really amazing actually. They are really, really good. So I will take a kind of like a step back and share from the ecosystem point of view. So I think what kind of excites me has been built for like the past 1.5 years, and it's actually intents and solvers. I think it has already achieved a wide amount of like adoption in general. It's kind of controversial because it could be pushed towards the centralized point of view, but we are seeing tangible leaps on that front. And I think it's pretty exciting because if you look at how blockchain in general and DeFi, which is a subset of it, right, has been making many attempts in terms of like pushing into payments. So far we have only co-opted payments for our own purposes, for example, like on-ramps, off-ramps, etc. But if you look at the payments industry, it's actually like $7 trillion. It clears $7 trillion a year. And it's really, really big actually. And DeFi, in comparison to that, is like a much smaller market share. But if you look at how advanced a lot of the DeFi applications right now is like using intents and solvers, we are going from an origin chain to a destination chain, and then we are also making cross-chain swaps in terms of one asset to another asset at the same time, while essentially using a infrastructure that's been slowly maturing over the past 1.5 years. I think that's pretty exciting, and like I do see us essentially participating in eating up that market share on the payments front, like in the future, and that really excites me because within the space itself, it's always about either creating of credit or like growth from market share, right? So I think that's more of the latter. I have a preference for the former, which is creation of credit in general, and I think we don't see that much innovation in intents and solvers now, but in the future, I think that could change. So for example, right, when you create an intent, let's say it's 100 USD, right, and then it needs to be solved on a destination chain by somebody else, right? But right now, we are always instantly solving those intents. What if we do not solve those intents? We collateralize those intents at that value, and we break down that 100 US dollars worth of the denomination down into like $1 each, for example. And we can do so much more with it, and that's kind of a creation of credit. But the intent itself needs to be printed back to the chain, and that's why it requires DeFi engineers to take a look at it, and that could be the next bleeding edge in terms of how we grow. So that's what excites me right now. Yeah.
Yeah, makes a lot of sense. I mean, DeFi, off-ramp, including off-ramp, on-ramp issue, the UX is not that great yet. Yeah, so yeah, I totally agree with that too. Leo, can you share your thoughts and
Yeah. So yeah, it's on. I agree with a lot of what Matt and Vivek and Daniel said. I think especially Matt and Vivek, the points you raised are really interesting. In general, I in my head I'd abstract it as you bring like there are going to be more, let's say, interesting business cases that we haven't seen before, because we're now, I think, slowly starting to step out of the crypto bubble and to connect more connections to the off-chain world, whether that's through RWAs, whether that's through a partnership with a bank, whether that's through, whatever, just connections to the world outside. And that enables new use cases, and that also enables new, like from the business side, new, different revenue models, different strategies that were just not available before, and that are maybe a bit more, I want to use the word real in some sense. But yeah, that just go outside of the crypto bubble, and that's, I think, fun and interesting. What excites me, I'll give a different spin. We're gonna scale Bitcoin, and we're gonna bring liquidity from different L1s together, and we're gonna build a very powerful DeFi environment that lives on on a layer that is connected to different L1s natively. So everything that we've saying so far is true and good, and I'll take a step sort of below that at a more fundamental level and bring all of that to like the whole sort of crypto ecosystem rather than having it siloed between single chains.
Thank you so much. Unfortunately, time is up. So thank you for joining us as a panel, and thank you all the fantastic panelists today.